Always
You
FIFO
have
friends.
holidays on weekends these
Always
days.
FIFO friends.
The weekends also keep us busy these days.
Okay. So the news which all of us read over the weekend about what's happening in with America entering the war, what is your assessment? Should one panic? Is it wait or watch, or this is an opportunity if markets go down?
Well, yeah, that's the most difficult question to answer. Obviously, it was expected. Market will react. I think there are scenarios that you can draw out, ranging from most likely to what you may want it to be the case or what you may not want it to be the case. I think the most likely is hopefully the tensions cool off without it escalating into a closure of the Strait of Hormuz, which is a big concern from an India perspective, because that will imply oil prices moving up sharply, and that will impact earnings sentiment and valuation multiples. So you take that out as an extreme scenario, then you are looking at tensions cooling off, some retaliation from Iran, and ultimately over the next few days, diplomacy takes over, and we're back to square one. We're back to fundamentals, we're back to earnings, and we're back to the focus on stocks and sentiment. Which way this will unroll, nobody knows. But the near-term impact will be obviously felt, and it will be felt across sectors. Now, the worst case of this, it escalates, and it escalates materially to lead to an earnings cut, and that is what I'm very apprehensive about at this stage. We're not building this as our official stance right now, but I think it is a real risk, because even if the crude sustains higher levels for the next month, couple of months, let's say a quarter or so, earnings will take a bit of a knockoff, and that could have a bearing on the upside potential that we see in the stocks.
All right. Hi, Amit. Morning. This is Shrishti also joining in. But what should be the best strategy at this point in time? Because a lot of these sectors, and especially the financials, was one of those consensus buy in the past 1 or 2 months. But back home, any pockets that you still like?
Well, we've backed up consumption, but obviously with these new developments, it continues to be facing some headwinds here and there. I think our stance right at the start of calendar year was that we would be prepared for a zero return on Nifty for the first half, which largely has worked out. The issue now is do we get into these headwinds every now and then, and it caps the upside, and we potentially building let's say a listless movement on the key indices, but play the bottoms up names. For example, we liked some of the names in consumption, we liked some of the names in discretionary side, even in the banking side, whereas there is a significant amount of concern on NIM pressure, and we do recognize that. There are some franchises that we continue to like from the small and the mid cap space. So I think that has been the preferred way we have been talking to clients, that let us not worry too much about the indices as long as the base level earnings are in place and there is lower risk to the earnings cut. And look at bottoms up names and allocate to those. So high beta is out. Capex related stories, we are slightly more on the back foot. So we are playing more on the domestic names and more on the domestic consumption side. One caveat, if I may add, has been large cap IT, which seems to be now very attractive from purely a dividend yield, free cash flow yield perspective. But again, the concerns there continue to be 3% growth. What are the multiples you want to play for that? So mid cap versus large cap, it's a mix that we're playing out for.
Do you like the dividend yield theme? Because of late, a lot of value seekers are saying in this market, buy stocks like Coal India, Bajaj Auto, HCL Tech, typically stocks which have a 3 to 5% dividend yield. Does it make sense to think on those lines, Amit?
Well, it does. Essentially, you're in a market which is not going to go anywhere. This is something typically we classified this in our latest note as an accelerating market. It's not going to go anywhere. Now, it doesn't let you go full bullish because there are headwinds. It doesn't let you go full bearish because you have domestic flows which continue to sort of enter at a certain price level. So it's a market which is not going to give you clear direction. And in that scenario, you want to build in some allocation to your portfolios wherein you have a certain dividend which is supportive of the valuation. And you also want to build in some defensive nature to your portfolio. And these perfectly in that way hedge your portfolio. So definitely, we've been of that opinion since the start of the year. And that as we've gone along, that hypothesis has only got strengthened further as we go along. Because ultimately, even in some of the IT companies, for example, while the growth rates are near 0 or 2%, 3%, the payouts are pretty healthy. And in some cases, they are paying out 80, 90%. So that continues to support their valuations. If that were not to be the case, then the valuation would not have sustained at these levels. They would probably have been even lower. So we do believe that there is a case to build for those kind of names to have in your portfolio, and especially in the environment that we are in, it makes even greater sense.
Amit, hi, morning. Just want to get your sense on the kind of sentiment we're seeing. Are you seeing even the slightest bit of the emergence of a broader risk-off sentiment, if at all? Because on the contrary, gold prices are softening.
Well, the risk off keeps happening every now and then. You had risk off happening in the first week of April, and then tariffs went back, 90-day window open, and we went back into risk off. But over the last about 8-10 weeks, we've not really had any decisive move on the market, and we believe that it will continue to be the case for the next quarter maybe. Headwinds will play out, you will have cool off, and then again people will come in to buy. But the upside is very clearly capped. The downside is protected unless you get to see a very decisive move, either a significant earnings upgrade or a significant earnings downgrade. I think we're locked in a very narrow range on the market, which may persist even for the second half of the year. That's the feeling we are now beginning to sort of align to.
But Amit, what about the real estate counters? Because of late we are seeing some of the news flows coming out on the positive side, where companies are not just entering new markets, but they are also highlighting the fact, the kind of revenue potential that they are targeting. And some experts believe that we are still in that bullish phase of a real estate cycle, wherein it does continue for almost a decade.
Well, I don't think I can make a call for a decade, but largely I think the pipeline seems pretty healthy. The launches are back, which was the concern last year because the launch pipeline had dried up. That's back. And as you get more and more launch pipeline, it sort of extrapolates the visibility that you have on cash flows. I think important thing is also how these companies deploy these fresh cash flows into new projects and what are the sort of ROEs that one can build on these new assets that they're acquiring. So far, the trend seems to be on the positive side is all I can say. So largely more on the positive side. Stock specific, I cannot talk because we don't have rating on the stocks per se there.
Okay, so that's the take on some of those real estate names. But let's deviate a little bit and talk about NSE's long-awaited IPO, because the path to that just got clearer. SEBI has put on hold its earlier proposal to separate clearing corporations from stock exchanges, a key hurdle that NSE has been facing. Instead, the regulator will now focus on improving transparency in trading and clearing.
No, in defense, definitely not, because some of these valuations are building an extremely high level of earnings sustainability. In some cases, we did a reverse calculation, and this is not again officially rated, sort of ratings. But some of these cases are building in even 25%, 30% odd CAGR growth for the next decade, which I don't think is going to be feasible. While defense as a theme has caught up, obviously, because of the policy action taken by the government and have a lot of other realignments to what we are seeing in the geopolitical environment today. But I think valuations there today do not sustain these kind of levels. On railways, I think there is a change in the sense that we are now seeing some bit of spending beginning to sort of take place. Last year was complete block of the working capital, order flows were pretty slow, and even the working of the orders which were awarded was going a little slow. So I think that's beginning to happen. Now that's stock specific what one would like to buy, but I think relative between defense and railways, one would be more sort of optimistic on railways because government capex seems to be building up really nicely and hopefully should be a support to the overall sentiment for economy also at large.
All right, Amit, what's your take on some of these pharma counters? We've seen a lot of regulatory action coming in from US FDA on the likes of Sun Pharma. You had Alembic last week. Today, there's news flow on Granules as well, wherein their Telangana facility, which is the paracetamol facility, has received one Form 483 observation. Amit, your view on pharma and which companies you're liking here?
Well, pharma, we think FY26 will be more of a consolidation year. And the reason we say that is that 24 and 25 FY, you had significant tailwinds which helped the sector to outperform by a wide margin versus the broader market. You had significant earnings operating leverage playing out. You also had new launches which provided the tailwind. I think this year you have a lot of those factors normalizing. And then also this overhang of the US trade tariffs, which will ultimately have some dent on the likely upside that you can see. So I'm not trying to sound bearish on pharma, but I think we've been more on the neutral mode. We continue to like JB. We like Ajanta as sort of small and mid cap plays. And on the large cap, it is more we're sort of more aligned to Cipla and Torrent at this stage. But in terms of expectations of returns that we are building in, they are relatively muted, I would say. And even the intuitive sense would have been in an environment wherein you want a risk off, pharma will be defensive. That's also no longer the case because supply chains getting impacted, logistics costs going up. We've seen how it played out in FY23 when the Ukraine war happened. So there are challenges that the sector is facing, in spite of being a good cash flow generator. So we're more on the neutral mode, but we like some of the individual names there. And I will probably keep my expectations slightly muted on FY26 returns from the sector.
All right, so that's about pharma. But with this, Amit would like to thank you for taking the time out and speaking with us and giving us your view on so many sectors that we just touched upon. Well, let's put the spotlight on Biocon. The company did close a successful 4,500 crores of QIP. So let's deep dive more into that and understand for what purpose the company is going to utilize this particular money and what's the way forward. We have been joined by Mr. Siddharth Mittal, who is the MD and CEO of Biocon, joining us on the show right now. Hi Siddharth, great to be speaking with you and thank you so much for your time. First up on this particular QIP, give us some understanding. What are the plans for deploying the funds raised through the QIP?